Current market data puts Datavault AI Inc., ticker symbol DVLT, trading right around $1.62 to $1.67, showing a sharp decline of approximately 7.34% in today's intraday session. The stock is actively testing the lower bounds of its recent consolidation range, currently sitting at roughly $1.62, down 13 cents from the previous close. We are seeing significant volatility right out of the gate this morning, with volume already beginning to swell as traders react to the divergence between the company's aggressive forward guidance and the immediate selling pressure hitting the tape. This price action creates a jarring disconnect that we need to examine immediately. You have a company that just raised its revenue guidance for 2026 to over $200 million, a massive jump from previous estimates, and yet the stock is red. The expectation here, the narrative that retail investors are buying into, is that Datavault AI is the next massive breakout in the artificial intelligence and real-world asset tokenization sector, a hidden gem that is about to explode like Nvidia stock did in its early growth phases. Investors read the headlines about an $8 million deal with Triton Geothermal and a $7 analyst price target, and they expect a vertical line up. The reality, however, is far more nuanced and gritty. The reality is that the market is currently forcing a prove-it moment on the company, selling the news despite the positive headlines, and questioning whether a company with a current market cap of around $500 million can actually execute on a pipeline that promises billions. This tension between the explosive press releases and the skeptical red price action on your screen is exactly where the opportunity and the risk lie. If the reality of their execution matches the expectation of their guidance, this dip is a gift. If the reality is that the cash burn outweighs the signed contracts, then the $7 target is a mirage. We are going to rip this apart piece by piece and look at what is actually happening under the hood of Datavault AI. Let's talk about the immediate trading dynamics we are seeing today. The stock opened at $1.79, tried to push higher, and was immediately met with a wall of selling. This is classic sell the news behavior. You often see this with speculative tech plays. The anticipation of the earnings call drives the price up. DVLT was trading significantly higher just days ago, and when the news hits, even if it is good, the short-term traders exit their positions to capture liquidity. You need to understand that for stocks like this, the trading psychology is often more impactful in the short term than the fundamental data. We are seeing heavy rotation, likely from retail traders using Robinhood stock trading accounts or the Robinhood app, who bought in during the run-up and are now panicking as the price retraces. This flushing out of weak hands is a critical technical event. If the stock can find support here at the $1.60 level, it establishes a higher low on the longer timeframe charts. If it breaks this level, we could see a retest of the $1.40 zones. The volume today is tracking higher than average, which suggests that institutions might be involved, potentially absorbing some of this retail selling, or conversely, distributing shares into the liquidity. When you look at the order flow, there is a battle taking place between the believers in the real-world asset narrative and the skeptics who are looking at the company's net losses. Now let's challenge the general belief about this stock. Most people looking at Datavault AI see it as just another AI penny stock trying to ride the coattails of the AI boom. They see AI in the name, they see a low stock price, and they think it is a lottery ticket. That is the surface-level view. The contrarian take, the deeper analysis, reveals that Datavault is not actually a pure-play generative AI company in the way you might think of ChatGPT or Gemini. It is structurally pivoting to be a massive infrastructure play for the tokenization of real-world economy assets. They are building the rails to put things like geothermal energy, carbon credits, and massive physical infrastructure projects onto the blockchain. This is a distinct difference. While everyone else is fighting for GPU chips and trying to be the next Nvidia stock, Datavault is trying to secure the data and the value of the physical world. This differentiation is critical because it means their revenue model is tied to the success of these large industrial contracts, not just software subscriptions. The skeptics miss this pivot. They are analyzing it like a SaaS company when it is trying to be a digital asset investment bank. We need to look closely at the news that dropped this week regarding Triton Geothermal. This is not just a fluff press release. There are hard numbers attached to it, which is rare for companies of this size. Datavault signed a multi-year services agreement with Triton to tokenize geothermal assets. The deal includes up to $8 million in upfront and milestone fees. That is tangible capital. Furthermore, they get a 5% participation in transaction fees tied to an estimated $125 million real-world asset offering. If you are using Fidelity investments or holding Fidelity ETFs, you know that finding small-cap companies with clear contract-based revenue visibility is difficult. This deal validates their technology in the energy sector. Energy is the backbone of the AI boom. Data centers need power. By positioning themselves at the intersection of energy assets and digital tokenization, Datavault is creating a very specific, high-value niche. The market reaction today, dropping 7%, suggests that investors either don't fully understand the long-term value of that 5% transaction fee, or they simply don't believe Triton will execute the full $125 million offering. This is the gap between expectation and reality again. The expectation is instant cash, but the reality is execution risk over time. Let's expand on the Q3 earnings, because the headline number was massive. Revenue was up 148% year-over-year to $2.9 million. That is a triple-digit growth rate. If you saw that kind of growth in Tesla stock or Apple stock, the market would go haywire. But here, because the base is small, the market is hesitant. They raised their 2025 revenue guidance to a low end of $30 million. Do the math on that. They just did roughly $3 million in a quarter, which annualizes to $12 million. To hit $30 million next year, they need to more than double their current run rate. Then they dropped the bombshell. They raised 2026 guidance to exceed $200 million. That is a projection of nearly 10x growth in 2 years. When a management team puts a number like $200 million on paper, they are putting their credibility on the line. If they miss that, the stock gets crushed. If they hit it, the current valuation of $500 million is absurdly cheap. A company growing to $200 million in revenue with high margins, assuming the licensing model holds up, would typically trade at multiples far higher than 2x or 3x sales. Currently, with a $500 million market cap and a $200 million target, you are looking at a forward price-to-sales ratio of 2.5. For a high-growth tech stock, that is bargain basement pricing. But again, the market is discounting it heavily because of the trust but verified dynamic. We also need to discuss the risks because I want to be very real with you. You are not going to hear this from the hype channels. The company has a history of losses. The earnings per share were negative 33 cents. They are burning cash to build this infrastructure. While the revenue is growing, the costs are high. The going concern language that often appears in filings for companies at this stage is a standard warning flag that you must respect. It means they need to keep raising capital or generating revenue to survive. They have successfully raised funds recently, which is a good sign of institutional support, but it often comes with dilution. If you are trading this in your individual brokerage account or through Interactive Brokers trading platforms, you have to be aware that secondary offerings could cap the upside in the short term. Dilution is the enemy of the early shareholder. It is the tax you pay for funding the growth. You have to weigh whether the $200 million revenue pot of gold is worth the potential share issuance along the way. Let's take a step back and look at the broader sector. The real-world asset or RWA sector is being touted by major financial players like BlackRock as the next frontier. We are talking about trillions of dollars of real estate, commodities, and art being moved onto blockchains to create liquidity. Datavault is positioning itself as the shovel seller in this gold rush. They are not the asset itself. They are the vault, the verification layer, the data intake engine. This is why they mention acoustic science and data science.
It sounds esoteric, but the acoustic science part involves verifying the authenticity of assets and data through unique signatures. It's a high-tech way of proving that a digital token actually corresponds to a real physical object. This is crucial for things like carbon credits, where fraud is rampant. If Datavault can become the standard of truth for these assets, their moat is massive. This is a far more defensible business model than just making another AI chatbot. I want to pause here and get a pulse on what you guys are thinking, because this is a complex story. Comment below. Do you believe the real-world asset tokenization trend is going to be the main driver for the next bull run, or do you think it is just another buzzword cycle? And also, if you are holding DVLT, let me know your average cost basis in the comments. I want to see where the community is positioned. Now let's look at the technicals on the chart in more detail. The stock has support around $1.55, a level it has bounced off previously. The resistance is clearly at that $1.80